Hello, this is Ernest Burley, your CIA, your cool insurance agent, back at you again with some more great information on insurance. I'm a licensed insurance agent with over 30 years experience with clients all over the country. Some of the areas of expertise that my firm deals in is auto insurance, life insurance, homeowners insurance, church policies, long-term care, disability, health insurance, all different types of insurance. And the purpose of this podcast is to enlighten you, educate you, and empower you with the tools of unbiased and objective information so you can make the right decisions for yourself and for your family. It's all about getting the right information in your hands so you can make good decisions. Don't get hoodwinked and don't have people just telling you things that are not true. So let's just get at it. I'm going to go ahead and get going on our podcast for today. Today's podcast is titled Universal Life Insurance. Don't do it unless, okay? Now, I've alluded to this podcast for many, many podcasts saying, hey, I need to do a podcast on universal life. So we're finally going to tackle that today because universal life policies can be very, very tricky. A lot of different moving parts. So we're going to talk about the main moving parts that you should be concerned about with universal life policies so you can decide whether that's a good plan for you or not. So here's some of the moving parts. You have account value versus surrender value. You have guarantees versus non-guarantees. And you also have current premiums or scheduled premiums versus future premiums, right? So those are some of the main moving parts. Now, the guarantee versus non-guarantee, that's huge, right? And your premiums, that's a huge deal right there too. So let's tackle that stuff. Let's take a look. Traditional universal life policies often conk out and leave a person without coverage at older ages. Now, this happens because the cost of the policy increases as the person gets older, but the person is still continuing to pay their same scheduled premiums, and that eventually catches up to them because as the policy gets more in cost, you're paying the same premium, eventually something's got to give, right? So for example, say you got a policy, this is what happened. People get policies, 10, 20 years ago, what have you, and they're paying 20 or 30 or 50 bucks a month for the universal life policy. Now they're 20 or 30 years older, and the cost of the policy may be 60 or 70 or 80 bucks a month or even more. Now the policy will continue to take your premium of $50, and what it will do is use your cash value to supplement your payment to make that payment full, right? So if your real premium or your real payment to keep that policy going is really $80 per month, but you're still paying $50 per month, the policy will take your $50 payment, take $30 from your cash value to make up for to make it up to 80. And that's how your policy will be paid. Now, eventually taking that money from the cash value is going to wear out. Siphoning the money out of the cash value is going to drain the cash value down to zero. Then you'll have no policy because then the premium that you're paying will be inadequate to pay for the policy and you'll have no more cash value to siphon off of. That's what ends up happening. And that happens at older ages when you're 60, 70 years old. And that's not the time you want your life insurance to start conking out, okay? So either you'll have to make substantially higher payments to keep the policy going or the policy will lapse. So let's not get ourselves into that type situation, okay? Now, I do not recommend traditional universal life policy. So I'm gonna put that right on out there, and I've said that many times before, don't do it. Don't do a traditional universal life policy because of the thing I just told you. Now, there is a way to tweak a universal life policy, a traditional universal life policy, and extend it, by basically paying more premiums into the policy. But, I recommend just not even getting into a situation like that at all, okay? And I'm going to talk about a solution to that in just a few minutes. Now, my next point, account values versus surrender values. So during the first 10 to 20 years of the policy, there'll be a difference between the account value and the surrender value of the policy. The account value is going to be higher. That's a higher number than the surrender value, because basically what it's saying is if you surrender the policy, which means you terminate the policy or cancel the policy within that window of time, normally it's a 20-year policy for a lot of universal life policies now, you won't get the entire account value. You'll get the surrender value, which is less. It's basically a window of time that you have to keep that policy to get the full value of the cash value. Once you get outside the surrender value or the surrender period, then the surrender value and the account value are the same. So like after 20 years, so year 21, you'll see the account value is equal to the surrender value of the policy in every year thereafter. Okay, so that's another moving part. If you surrender the policy, you're looking at your account value, and you say, "Oh man, I got $5,000 in there. That's my account value." But you better sneak over to that surrender value, and after maybe 8 years, you say, "Well, my account value is 5,000, but my surrender value is maybe 3,000." Right? So that means if you surrender the policy, you're not going to get the 5, you'll get the 3. Okay, so know that about universal life policies, and that's for all types of universal life policies. You have those two columns, the account and the surrender value, and they change values. The values are different during that surrender charge period until you get outside of it, and then they stay the same. They're the same. Now, here's a tip. If you are interested in the cash value feature of a policy, say a permanent policy like this, universal life plan can be turned into a permanent type plan. Whole life is a much better way to go. Now, if the cash value is not important to a person, then a guaranteed universal life policy, which we'll talk about in a few seconds, is usually a better option. It totally depends on the age of the person and the rating that they'll receive. If you're going to get a standard rate or a preferred rate or a super preferred rate, then the premium between the guaranteed universal life policy and a whole life policy is not that big a difference, maybe 10, 20 bucks a month. If that's the case, whole life is the no-brainer way to go, because the cash value in a whole life policy is exponentially higher than it will be in a universal life policy, guaranteed universal life policy, what have you. So yeah, you definitely want to do that if that's the case. But if you have a budget issue and the difference in the premium between the two policies is more like 30 or 40 or 50 bucks a month, then you have to think about it and say, okay, well, do I really want that? If cash value is not a big deal to you, you just want to make sure your policy is going to stay the same, the premium is going to stay the same, and your policy is going to stay in force for life, then don't worry about the whole life policy, okay? Don't worry about it. But if the premium is going to be nominally different, just a little bit difference between the two, yeah, you get that whole life plan. Okay, so that's a tip on the whole cash value situation. Now, next point I want to make, another one of the moving parts of universal life policies, guarantees versus non-guarantees. So you have sections above the cash value and the death benefit of the policy. So look at those sections and look for the guarantees. Now, the guarantee section will be normally to the left of the illustration. You'll have your age, and then you have the premiums you're paying, and then that next section, that next block of numbers is going to be the guarantees normally. And then normally there are two other sections that are non-guarantee sections. Rely on the guarantee sections, okay? You don't rely, who relies on non-guarantees? Not a wise person, okay? So rely on the guarantee side of these universal life policies, not the non-guarantee side. I always look at these illustrations and I'm like, yep, if you go all the way down and look, you'll see the zeros. I just talked to a client about that today. I talk to clients all the time about looking down to see where the zeros are, or the lapse, the word lapse is in these universal life policies. That's on the guaranteed side. And then eventually you will see it on the non-guaranteed side too, but it's further down the line. It's saying, okay, the life company is saying, hey, we don't guarantee it will last this long, but if you want to, wager your bets there and hope for it to go that long, then we'll non-guarantee that it may last this long. But this is what we guarantee. We guarantee it's going to last this long. That's what you rely on. Okay. Now, guaranteed universal life policies, I endorse those all day long. Okay, I write them for clients all the time, unless whole life is a better option. But guaranteed universal life, if you're looking at universal life insurance, I would highly recommend guaranteed universal life insurance. Now, I endorse it with a caveat though. Guaranteed protection is provided to a certain age, right? So the term guarantee makes the policy seem like a slam dunk, right? But the policy has to be written correctly, because I've had clients send me illustrations for guaranteed universal life policies, but the person that is trying to write the policy for them illustrated or guaranteed it to like age 70 or age 80. No, we want to guarantee. When I illustrate those things, I illustrate them, I guarantee them to age 121. And that's normally for younger clients. Now, when a client's older, then maybe I'll back it down to 110, but you want to illustrate at least or have it guaranteed to at least age 100. Is very, if a client says, hey, I want to guarantee to age 100, then I'll do that. But the cost difference is not really that much between 121 and 110 for most clients, unless, like I said, you're older. When you start getting older, then yeah, it makes a difference in cost, but then you have to figure out whether it's worth it to have the premium be less for saving yourself, well, not wiping out basically 10 years of coverage. So, at least 100. I like to go to at least like 105 or 110 on those illustrations, but at least 100. Don't have someone guaranteeing your policy just to age like 70 or 80. I've seen that before. That's not a good thing. So there you go. The guaranteed universal life policy, I do endorse those, but it has to be written properly, guaranteed to the age beyond the age to where you think you won't outlive it. Basically, let me put it that way, right? So it needs to be guaranteed to a reasonable age. And I think a reasonable age is at least age 100. And if you're younger, definitely 121, because there's no difference in cost, okay? Now, learn how to read those illustrations. We talked about that in the previous podcast about how to read an illustration. I have a podcast titled 6 Easy Steps to Read an Insurance Illustration. So please check out that podcast so you can see these columns I'm talking about, these rows I'm talking about. It's very easy once you kind of break it down and look at it the way I'm asking you to look at it. Now, last thing I want to talk about is option 1 versus option 2 death benefit. So there are 2 different death benefits on universal life policies. Option 1 is normally called the level death benefit, and option 2 is normally called the increasing death benefit. And the reason why is because option 1 includes the cash value within the death benefit. So the cash value has to be used while you're living, or you lose it, basically. Use it or lose it. Versus option 2, if you don't use the cash value while you're living, the cash value gets paid to your beneficiaries. Okay, so that's a sweet deal, right? So here is an example. Say you have a $100,000 policy and it has $20,000 of cash value in it. If you don't use the cash value while you're living and you pass, your beneficiaries under option 1 will get $100,000. But if you had option 2 in that policy, your beneficiaries would get the $100,000 plus the $20,000 of cash value. They would get $120,000. So that's the advantage of option 2. Option 2 versus option 1, normally there's not a big cost difference when you're at your younger ages, but it does cost a little bit more. You can start seeing that cost vary and get a little bit higher when you start getting older in age, okay? So you make a decision as to what you want to do there, option 1 versus option 2. A lot of times those plans are sold at option 1 because that's, normally the less expensive option. But like I said, option 2 is not, is a nominal difference, if any at all, at younger ages. When you start getting older, then yeah, there is a cost difference. So there you go. That's it. Those are some of the triggers on universal life. So universal life insurance, don't do it unless it's a guaranteed universal life policy and written the right way, which means guaranteed to at least age 100. If you're younger, which I mean like in your 30s or younger, or even your 40s or younger, it should be guaranteed probably to age 121 because the cost is going to be about the same. When you start getting older, like, up in the 40s or 50s or what have you, then it's going to cost a little bit more, but then just look at the cost difference. It's not that much. It depends on what rating you're getting. If you're getting a preferred rate or super preferred rate, probably won't cost you that much difference to have those additional years of coverage guaranteed for you, okay? But don't have someone illustrate something and it's guaranteed just to age 70 or 80 or 90 or something like that. That's not good, okay? But now you know how to read the illustration, you know the columns to look for, so you'll know if someone's trying to feed you something like that, trying to bait you in. We talked about bait rates too, right? So let's not get caught up into that situation. So that's it. So our recap for today is to steer clear of traditional universal life policies. Steer clear of them, okay? The takeaway is to compare the guaranteed universal life to the whole life. If you have permanent life insurance need, compare the permanent life insurance needs, compare those two to see which one works in your best interest, okay? So that's my takeaway for you to say, okay, well, let me see if this guaranteed universal life is the best way for me to go. If budget is a concern and you just want permanent coverage, not concerned about cash value, boom, go for it. If you want cash value, you're really thinking about that, then whole life is the way to go. Or if you're receiving a very good rating and the cost difference between the two is not that great, then whole life is the way to go because of the cash value feature. But guaranteed universal life is going to cost less than whole life because the cash value is going to be substantially less. You do what's in your best interest, right? You just have the information. I want to thank you for listening. Thank you for listening to this podcast. As always, I appreciate you guys so much. Please forward this podcast to others and ask them to do the same, and so on, and so on, and so on. So the podcast can become viral and everyone can have all this unbiased, objective information so they can make the right decisions for themselves and their families. If you want to reach out to me and connect with me, the best way to do that is email me, ernestburleyjr@gmail.com. That's just my full name at Gmail, ERNESTBURLEYJR@gmail.com. Or you can call my firm at 301-262-2600. Again, that's 301-262-2600. Now, all of my podcasts are on YouTube, so please go to my YouTube channel and subscribe. I mean, I'd love to get you guys to subscribe and, forward that information to others so they can subscribe to the channel and check out the various podcasts that I have on there. And I also have some 1-minute snippets of different aspects of insurance and, different types of insurance and just different things all together, like real estate and succeeding in your career. So they're like 1-minute snippets on various topics of insurance and other topics. And there are also podcasts on various subject matter that I think will help you out. Okay, so that's it. That was a short podcast, right? Just get right at it. So until we meet again, until we speak again, this is your cool insurance agent, Ernest Burley, your CIA, signing off. Until we speak again, take care, be safe out there. All right.